Most people hear crypto and think Bitcoin, Ethereum, Dogecoin, and a bunch of other coins people trade. What if I told you that you can use your crypto to buy, sell, and trade real world assets such as stocks, gold, or silver, oil, and other foreign currencies, all without even leaving the blockchain? Better yet, what if you can earn high passive income dividends up to 300% APY from just holding onto these stocks on the blockchain? So, how does this work? First, we gotta understand what liquidity mining is, and then second, what synthetic assets are. First, let's start off by explaining synthetics. So, everyone is familiar with stocks and how they generally function. The majority of you watching this video are probably holding a few stocks of some kind. They are without a doubt one of the easiest financial products to understand, and that's what makes them appealing. They're also very popular amongst new and mature investors since they have outperformed most asset classes in the last few decades. But now, how do we get stocks or other real world assets onto the blockchain? That's the main question. Because with synthetics, you're not actually buying company issued stocks. So the question, what do you really own? So here's a very quick and easy to understand example, right? So first off, let's pretend Adam and Josh are both in South Korea and they don't have access to the US stock market, but they still want to purchase Amazon shares. So what they'll do is they'll put a chest in the middle of the room and they both deposit $50. Initially, they both deposit $50 into it. And they both agree from now on that the chest will represent one share of Amazon stock. If the price of an Amazon share is $100 today, then the chest is also worth $100. However, if the price of an Amazon share increases to $150, then they'll both add $25 into the chest. So 25 from Adam and $25 into the chest from Josh. And it goes into the chest. So now, because the Amazon share is worth $150, chest is also now worth $150. So no matter what the price of an Amazon share changes to, the chest will always equal its same price. So Adam and Josh can then speculate on the Amazon stock by buying and selling the chest from each other without needing to be in the US or owning the real stock. This chest is what you call a derivative, which is getting its value from the price of the Amazon stock. And synthetics take this even further, because this is just a derivative. So let's go on to synthetics now. So synthetics track the price of a real world asset by using a third party decentralized oracle such as Chainlink, right? Now, I don't want to go into depth about what an oracle is. I'll make another video on that if you guys really want me to. But essentially, an oracle is what allows you to get real world data onto the blockchain, right? So this real world data can be such as like who won the last game, Real Madrid or Barcelona, who so who won the last match in UFC, what's the weather like yesterday and today, what's the weather forecast, what's the price of a stock. So all of this data, you're able to bring it onto the blockchain using an oracle, right? And the thing is, with oracles, they're decentralized, so no one has real ownership of them, right? No one single person, and they're always verified before bringing that data onto the chain. That way, you don't have to trust a human to bring that data for you that can have ill intentions and manipulate the data before bringing it onto the blockchain. So the other thing with synthetics is that, so that's how they track their price, right? Synthetics use oracles, which are much better. So another thing is instead of a wooden chest, there's a crypto token, BEP20 token or an ERC20 token, for example. And this S Amazon, which behaves exactly like an Amazon share. So instead of Adam and Josh carrying around the wooden chest, they can get anyone in the world involved simply because S Amazon is borderless and decentralized, and it can be traded anywhere in the world. So by holding the synthetic version, you're able to get exposure to the real world asset without having to hold the real thing. In short, synthetics are just tokenized real world crypto assets that behave just like the actual real life asset that they represent. So you might be wondering, what's the point if I could just buy them from Robinhood, right? What's the point of having synthetic assets if I can just get the real thing? Well, here's the thing. Do you remember what Robinhood did, right? When they stopped people from buying GameStop stocks? Why should they have the ability to ban and unban people from buying a stock? That shouldn't be happening. So the benefits with synthetics is that first, they're decentralized and they're community owned. So there's governance in place. The community essentially owns these synthetic assets, and they're able to govern what happens to them and what doesn't happen, right? So if you're a holder of it, you're part of this community and you're able to vote. Another thing is that they're frictionless, permissionless, and censorship resistant. So they're frictionless means it's very easy to use. All you need is a wallet address. There's no paperwork to fill or any onboarding to go through or any meetings or anything. And permissionless is you don't have to get permission from someone to use these synthetic assets. They're open to the public and they're censorship resistant. So essentially, there's no one to stop you from buying it, and another really important thing is if you're outside the US, you don't need a US stock broker to buy the stock. And the same thing if you're outside of South Korea or outside of Russia or something, you don't have to go through a local domestic broker in those countries, right? Another really cool thing is that there's 24/7 access to buying and selling these stocks, these synthetic stocks, unlike the actual stock exchange. And lastly, what's the most important? Sorry, this isn't the last thing, but what's most important is that you're able to combine these synthetic stocks with DeFi protocols. And the reason you're actually watching this video and I'm able to make this video is because we're combining synthetic assets with liquidity mining, which is a really cool DeFi protocol and DeFi earning strategy. So lastly, this what allows for capital efficiency is that instead of having to swap between USD when swapping between two different stocks, with synthetic assets, you could actually swap directly between. So if I have one Tesla stock, I could go ahead and swap that for an Amazon stock, and I could get 0.8 or 0.1 or 1.2 Amazon stocks in return for a Tesla stock. So these are all the benefits of synthetic assets, and if you want to participate and buy some of these synthetic assets, you could check out Mirror Protocol, which has a lot of stocks and different assets, and these are all synthetics, right? And another one is Synthetics with an X at the end, and that's on the Ethereum chain. Mirror is on Luna Protocol, which allows for less gas fees. So now that we know what synthetic assets are, the next important thing that we got to know is liquidity mining, because it's a strategy we'll use to generate passive income from the synthetic assets. So in short, liquidity mining represents a new way of using cryptocurrencies by providing liquidity to these decentralized exchanges. And the motive for the exchanges is to attract liquidity, which allows users to make more efficient and cheaper trades with less fees. And the word liquidity comes because it's the injection of liquidity. This injection of liquidity by investors then allows them to mine tokens that are rewarded to those who provide liquidity. So let's give an actual example. Let's say there's this pool of Ethereum and S Ethereum, right? And I want to deposit liquidity. So what I would do is I would combine an equal amount of two assets, which in this case is Ethereum and S Ethereum. And let's say I wanted to deposit $2,000. So I would take that $2,000, split it into two. So I'd buy $1,000 worth of Ethereum and $1,000 worth of Ethereum, and they have to be equal amounts. And then I would pair these equal amounts together, and I would deposit them into the pool. Then this pool would reward me in a generous interest rate as long as I leave the liquidity in there, and I can remove the liquidity at any time. And this interest rate comes from the exchange rewarding you for providing liquidity. So it's kind of like them renting out liquidity from users. And you own this liquidity at all times. They don't own it, they can't touch it or anything. Another thing you'll receive is trading fees proportional to the amount of liquidity you supplied in comparison to the entire size of the pool. So let's say the entire liquidity pool is worth $10,000 and you supplied $2,000, which is 20% of the entire pool, right? So you own 20% of that entire pool. So let's say this liquidity pool generates $500 in trading fees. You would receive 20% of the fees. So that's $100 just from trading fees. So now comes the good part. Now that you know what liquidity mining and synthetic assets are, we're going to be combining both of these together to earn high passive income on our stocks. We're going to purchase decentralized synthetic stocks and pair them with USDT and deposit them into liquidity pools to earn yields north of 300 to 250% APY. Sometimes it's even higher than that, and we'll be doing all of this on DeFi Chain. So like I said, instead of using Ethereum and Ethereum, we'll be using a stable coin called DUSD, and we'll be using stocks, any stock that you guys want to choose. So for this video, we'll be looking at DeFi Chain. That's the platform we're using to get these yields. They have the highest APY for stocks and LP. So first, let's review DeFi Chain. So DeFi Chain is a blockchain that was created all the way back at around 2019, and they had a goal of bringing DeFi to the Bitcoin ecosystem. So the blockchain is built on top of Bitcoin as a software fork, right? And it's tied to the real Bitcoin blockchain using a Merkle root every few blocks. And it's a hybrid proof of work, proof of stake chain. Basically, the way it works is it utilizes proof of stake on its chain to verify transactions and whatnot. And then it anchors itself to the Bitcoin blockchain, and that's where the proof of work actually is. And it gives itself the security and the immutability of Bitcoin, but with much faster speeds. So it's kind of like a layer 2 scaling solution, just how there's Ethereum and Polygon. And I'll leave their white paper down in the description if you'd like to know more about the technical aspect. So anyways, let's get into the main part of the video. So to begin earning high passive income on these stocks is you're going to have to download the DeFi Chain wallet app. So you can either get it on iOS and Android on your phones, or you could download it on desktop, either on Mac, Linux, Windows. So they support almost every single thing. And then once you have it downloaded, you're going to want to go ahead and open it up. And the first thing you'll notice is that you're going to have to synchronize your application with the blockchain. So you have to connect with different peers, and they would have to synchronize your application with the blocks. And this can take up to 2 hours. It could take maybe 10 minutes, 20 minutes. It's using peer-to-peer. So it's there's a great deal of variation. It depends like where you are in the world and whatever. So just don't be surprised if it takes some time, right? So once you're synchronized, you're gonna want to go ahead and create a new wallet address, because you can only create it after you're synced up with the blockchain. So to create one, you just press on receive, and then press on receive new create new address, and just give it a label like my new wallet. And there's advanced options to choose between a default or legacy wallet. Just go ahead and use the default one, and then just press create. And now you have your address. So once you have your address, you're going to want to fill it up with money. So the way we'll do that is you just press on receive, and you have your wallet address here. So you would have to go to an exchange, and you would want to deposit either DFI or BTC, right? You could deposit main chain Bitcoin onto this. But I would recommend using DFI, and the exchange I would recommend is going through KuCoin or Hotbit. Both of those work really well. So once you have your DFI and your Bitcoin inside of here, next thing you want to go to is the DEX, and then select either one of your currency. Let's say you deposited $1,000. Now you're going to want to split this $1,000 equally, so $500 on a stable coin, which is the USD, and then the other half to the stock that you want to earn dividends on. So let's say I got 500 of DFI over here, and then I would select the USD, and I'd get $500 worth of it, and I would make my swap. For some reason it's glitching, so let's just skip over this part for now. Okay, there we go. So I'll do 600 and then just continue and make the swap. And then next thing would be the stock that I want to buy. So I'm looking at Amazon stock or Apple stocks right here. We'll go for Apple, and I'd buy same amount, $500 worth of Apple stock. And once I have those two together, I would find the pair that I could earn yields on. So right here it says Apple and DUSD. I would press on this plus sign to add liquidity. So I'd enter the total amount of my stocks that I have and then the DUSD that I have. And you would want to select your wallet that you want to receive the receipt for your deposit of liquidity at, right? So they call them shares. And you press that, you swap, and you press continue. And from there, that's pretty much it. You've added your liquidity, and then you'll be receiving your rewards, passive income in that's paid out in DFI token, right? So you'll be seeing that you receive passive income, 102% APY on your stocks just while holding them. That's really, really crazy. So also another thing to keep in mind is transactions here on DeFi Chain, they're quite slow. They're because it's actually a slightly older blockchain platform. It's not like the new blockchains that we have, like Avalanche, Solana, Binance Smart Chain. So transactions on here might take up to a few minutes for them to confirm. So don't be surprised with that. Right, so that's it for the tutorial. Guys, enjoy your passive income, your high dividends. This is a really good opportunity to make a lot of money off of this liquidity mining program. Anyways, guys, you made it this far into the video. Go ahead and drop a comment mentioning how you're feeling about the crypto market, how you're feeling about the strategy, about what you learned. And if you have any questions, drop them down below. I'd love to answer them. Right, take care, everyone.